Good morning, everyone. This is an update for global stocks and commodities for the 18th of November. Market's still very volatile, backwards and forwards. Rallies seem to be getting sold now rather than if you go back earlier in the year and over the last couple of years, there's been a tendency for people to buy into the declines. Now we're not seeing that as much. The rallies are fairly weak, and there seems to be a readiness to sell into the rally. This is fairly typical of a bottoming process, which is what I think the odds still favour this being, and it may last a little bit longer yet. So we're still in a period of uncertainty. At least the US midterm elections are out of the way, so we know what the market reaction to that is, and it's, as always, when Washington is impeded from doing things, then the market is pretty happy about that. So that removes that one. We've still got the trade war and the intellectual property war as well, which is, I think, really a lot of what that's about, and that's why neither side is going to back down because it's so critical to them. But there's still concerns out there. Europe is not going nearly as well as it was a couple of years ago. So there are a few storm clouds, but certainly the American economy is still going along very well. An American reporting season was extremely good. It was as good as the prior one. So let's jump in and take a look. This update, I just want to try and give you a little bit of a sense of how this bottoming process is unfolding, but it takes time. And I think what is happening is that this is probably signalling a major multi-year rotation process. What I mean by that is we've had a number of years where the US market didn't worry too much about some of the valuations in technology and stocks like Facebook and Amazon and Twitter and all of those sort of high-tech, high-growth stocks were punted up to staggeringly high PE multiples. And I think that that game is probably finished now for some time. It may come back in the future, but I think it's finished for a while, and I think there's a good chance that we're actually seeing a big picture rotation from those really high PE momentum growth stocks, and there seems to be a resurgence now into what is known as value stocks, so stocks that are undervalued. And I think there's a bit of a perception in the marketplace that value stocks are stodgy and don't do much. But when you can get into a sector that has been deeply out of favour for some time and presents real value, the rebounds in value can still be very substantial. They can still be 30 or 40%. So, there's no need to sort of be despondent about the fact that growth stocks may not do well for the foreseeable future, because value stocks can still provide excellent opportunities. But you've got to get into them early. You can't really wait until everything's pretty obvious. So I think that's what's unfolding at the moment. Now, Portfolio Analyst last week, I had a question on Aussie banks, so I looked at that in detail at a big picture level, and why I believe that the best days for the Aussie banks are certainly well and truly done now. I'm not predicting a significant fall in the Aussie banks, but I just can't find the case where the Aussie banks are going to go up in value, and in fact may go down in value sufficiently to offset the dividend over the next couple of years. So I think that was a pretty clear case, and if you have a significant proportion of Aussie banks in your portfolio, then I think you would benefit from having a look at that episode of Portfolio Analyst last week. I also looked at energy stocks, and I'll be revisiting that again this week because obviously the energy sector's been sold down heavily, but there was some pretty significant turnarounds on Thursday and Friday in the energy patch from deeply oversold. And I also looked at a very exciting Australian food distribution business as well that I think has enormous upside over the medium to longer term. Now let's look at American stocks. The S&P was down 1.6 for the week. And my view is that this is looking a lot more like 2015-16, when there was serious thought given to the fact that the bull market was over. And in fact, for a period of about 2 weeks, I actually declared that it was over and that you should go defensive. And then, of course, it immediately tricked us all and reversed straight back up again. I think we're looking a lot more like that now than we are to the just quite recent period in February 2018. So we'll take a look at the charts on that. Now, I can't say that it won't happen, that this isn't the end of the bull market, but to me, there's just too many positives. I've covered this over and over again. All the major precursors are absent, but I'm certainly open-minded to changes in those precursors, and I'll show you a chart in a minute, which I think is also another great indicator that will give us 3 to 6 months warning of the next recession. So I'm still of the view that this bull market is still intact, because there are a lot of positives, but I'm certainly open-minded to other outcomes. One of the big unknowns for me, and it makes me a little bit nervous because we've never been there before and it's being done with such gusto, is that the US has never stimulated their economy when they've been at full employment before, and full employment being, anything less than 4% unemployment. And of course, that's what's happening at the moment because of the tax cuts. And if the Republicans had held their power in the Senate, then there would have been a second round. Sorry, not the Senate, in Congress. Then there would have been a second round of tax cuts put forward. So the fact that there's this, yes, the Fed is removing stimulus by winding back their bond buying program and raising interest rates, but these tax cuts are pretty substantial, and it's increased the US deficit massively. So for that to be happening at a time of full employment it's never happened before, and so I think we're entitled to be a little bit cautious about how that might play out. I think it's important to stick to the sensible economic facts, though, and not supposition, which a lot of people are doing about what's going to be the outcome of the trade wars or what the government deficit may do. So a lot of commentators are putting forward hypotheses on how that might lead, and it's just a guessing game. Just until we get some more concrete facts, it's better just to stick with sensible economic facts. And I think this next chart is one that's that's pretty definite and one that you can monitor. Now, the US dollar did fall over the last couple of days, and it's really a guessing game of what the Fed's going to do. Would appear that a little bit of weaker data might have taken the gloss on the rate of increase of interest rates, and therefore the US dollar went a bit lower. But it's purely guessing. This is the chart that I was referring to. This is showing the a 4-week moving average of initial jobless claims, which is effectively the level of unemployment. And you can see the grey bars there are the recessionary periods in America, and the blue line shows you those initial claims, and you can see that those initial claims bottom out about 3 to 6 months in most cases before a recession takes hold. So it's when the jobless claims start to turn up. Now you can see where we are at the moment, that the level of initial jobless claims is lower than it's been since before 1975. So this is a fair slice of history. It's more than 40 years worth of history. We're now within that view, we're now at an all-time low, and yet the stimulus going into the economy. Now, at some point, those jobless claims will turn up, and that's when we need to start, really looking hard at some of the other indicators. It's only one indicator, but nevertheless, it's a pretty clear-cut one. So when we see those initial jobless claims start to turn up, then we certainly need to move into more cautionary mode. let me just look at the S&P. So this is the S&P index. This is the working model that I've got. A move above 28.20 would be positive because it would set a new short-term high, and a low below 2600 would also do the same. But then we've got the February low, of course, down here at 25.35. So you can see that we're still within this band. It's really too hard to say which way this is going to go, but looking internally, looking at intraday charts, looking at a lot of the sectors, I can tell you that things aren't looking all that positive at the moment. So I don't believe that this corrective period is finished. I think we're in a bottoming process. I wouldn't rule out some new lows in the index below 2600. But you can see just some observations about the comparison with February. The February only touched the 200-day moving average and then rebounded very strongly, and the 200-day moving average was going up quite strongly and was uninterrupted. We then got a retest of those lows in April, and we ducked under it for like 1 day at the most, and then it just continued on up again. Now you'll notice now, however, that we're spending most of our time below the 200-day moving average, and the 200-day moving average has turned over. So that is a change of character compared to what we had back in February. And if you go back and take a look at where we were in 2015-16, so this was the initial plunge in August. We then managed to scramble back to the highs in November, and then it fell apart in January and February. And you'll notice we then took out the swing lows. So we took out the August swing lows, and you'll notice that by mid-December, the 200-day moving average had also turned over again, and we were spending most of our time below it. So a lot more similarity between what we have here and what we had back in 2016 than what we just saw earlier this year. So I think that's pretty clear. So the key for me, or the ultimate key for me, would be I would not want to see a break of the February 8 low, which came in at 25.35. So a break of that point would not be a particularly good thing. But as you can see here, we broke it on the 15th of January. We retested it again on the 11th of February, but then quickly regathered momentum. So you can always get false breaks, but to my mind, when you get a setup like this, you need to act on it. If the market subsequently, a few weeks later, indicates that it was a false breakdown, then you can always get back in. But you don't want to hang on hoping that this is not the end of the bull market, because if it is, then significant damage can get done very quickly. So that's the picture on the S&P. Just lock into your mind that particular shot. You can see how close the S&P is to the 200-day moving average, and also where it is in relation to the peak that was formed in the middle of October. Let's now look at the NASDAQ. You can see that the NASDAQ is in a worse position. We weren't able to make it back to the mid-October highs. We're significantly below the mid-October highs. So the NASDAQ is underperforming, and that's a reflection of the FANG stocks being sold down more heavily, and other high-tech names. And I still think the way that institutional buying and selling goes, that we've got some more to go in that process yet. And if we also look at the Russell, which was one of the outperformers for a lengthy period of time through 2017, we've now had an even bigger breakdown in the small caps. So we're well off our mid-October highs or peak, and we're significantly lower than the 200-day moving average. So the S&P holding up better, the NASDAQ showing the signs of the FANG stocks being sold, and the small caps are copying it even worse. So, technically there is certainly some damage being done, and you can't not acknowledge that. And so hence it's just so important to be open-minded about what the market is actually telling us, because whilst the economy looks good, corporate profit results are great, we've got to take note of the price action. But at the moment, for me, it is still a bottoming process. It is not the end of the bull market. That's the message. Just have a look at the US dollar. We're still in an uptrend. We're still forming higher highs and higher lows, but you can see there was a reasonable dip on Friday. And just while I'm here, I'll just show you how that transposed to the Australian dollar. So the Australian dollar, for the first time in quite some time, has now formed a higher high. Now, this is only very short-term stuff, and that can always fairly promptly reverse back down again. But at least we're now getting higher highs and higher lows in the Australian dollar. Let's look at the ASX 200. A pretty ugly week, down nearly 200 points, selling across the board, and certainly smacked of overseas institutional selling, because if you look at how the top 20 stocks were treated, they were all under very significant pressure. And the volumes were such that it was pretty big players who were liquidating. So Aussie stocks, so I've pretty much covered all that. We're down 3.2%. I think the reward for risk on the top 20 stocks in Australia is pretty unattractive. It's hard to see very much upside, if any, other than just, a bit of a bounce from being oversold. And yet I believe there is still downside risk in the top 20. So I just don't find it attractive at all. I think the two places to be fishing in the Australian market are for small caps that have got a strong niche and a very strong business, according to the model that I showed last week. And I'll show it once again, because I think it's just such an important guide for people that are looking to do their own fundamental analysis. And also the other area is there are some stocks in the top 100 that are dominant in their particular niche, and as a consequence of that market dominance, they're in a very strong position. But they were expensive. They were overbought and they were expensive. And stocks like CSL fit into that position very much. Great, tremendous businesses, but they were just ridiculously expensive. But some of those, not CSL unfortunately yet, but some of those stocks, and I'm covering those in Portfolio Analyst, are now heavily oversold, and they're back to a reasonable valuation. They're by no means cheap, but they're at least back to a reasonable valuation. And I think a decent rebound from heavily oversold of the order of 20 or even 25% is entirely possible. So they're the areas that I'm looking for most keenly in Australia, and I'm finding some. Turning now to precious metals, gold was higher to 1222. It has now formed a higher low, and I really am starting to warm to the concept that we might see a little bit better patch from gold. We need, however, a higher high, which means we need a break above 1245. We'll look at that on the chart in a minute. Precious metal stocks, GDX is still not leading the way. However, it's really moving a little bit independently of gold, but it's certainly not leading the way, which is what you normally want to see for the renewal of a major bull market in gold. So I don't think we're there yet. If you want exposure to gold, to me, the super majors that the GDX reflects just aren't attractive. They're running down their reserves. They've been under exploring. A lot of them have cost of production, which is above the current US dollar gold price. So the super majors aren't attractive at all, unless we see a much higher gold price above, say, $1,350, $1,400. To me, if you want exposure to gold, it's impossible to go past the Australian mid-cap producers. They're the highlight, but they've also had a run up, so you want to make sure you're buying those when they're oversold as well. So let's take a look at our at gold on a weekly basis. So here we've got, at this point, a higher low. What I want to see is a move up to here. So we want to break above this little previous high from about 3 or 4 weeks ago. So we need to get up above 1245 and close above it for for gold to be looking better than it is at the moment. And of course, GDX on a weekly chart is not really showing as much. It's just languishing down there. Okay, let's move on now to other commodities. Copper was up a little bit, up about 5 cents on the US dollar weakness. Crude oil, though, has just come off so heavily from the peak. It was only about 6 weeks ago that it was trading at $76, and for all the money looked like it was heading to 90, 95 because it had just broken out. Now that's turned out to be a false breakout, and within 6 weeks we've fallen 26%, and it's been an absolute smashing for the whole sector. It's due to a couple of things. Bearish inventory reports certainly haven't helped, and some concerns over global economic growth have really caused crude oil to fall that far. It's broken several key support levels, so I don't think we're going to see crude oil back in the mid to high 70s anytime soon. But it's just so unpredictable, and I covered the energy sector in Portfolio Analyst last week in response to a member question about where I thought the crude oil price was going, and my response was, I really have no idea, because it's just too political for me. There are too many vested interests that are making decisions that move the market significantly in very short periods of time. So I'm just looking for opportunities in really high quality energy stocks that are just ridiculously oversold, and therefore the chance of a rebound is very high. So I don't concern myself about where the oil price is going. I'm just looking for those shorter term trading opportunities. And I'll be covering that again this week because we did get such a strong reversal on Thursday and Friday. We got a really nice reversal on Thursday in energy stocks, the big stocks, and I'm not talking about speculative stocks here. I'm talking about stocks in the States of 30, 40, 50, $100 billion. There was a nice reversal on Thursday and then very nice follow through on Friday. So I'm going to be covering that in Portfolio Analyst this week as one of the feature sections. There's the spot copper chart. You can see not a lot of movement. It's been pretty sideways now for some time. And I showed you this chart, which is the 1 year copper warehouse levels in the London Metals Exchange. We had a sudden blip 2 weeks ago, but that is starting to sag back down again. And there's the crude oil chart. It's been a huge fall from 76 down to 56. And if we look at that on a slightly longer time frame, over a year, you can see just how big that fall has been, and it's taken us all the way back down to the February lows. So quite a huge fall in crude oil. So to wrap it up, you just got to expect the volatility to continue. It's unrealistic to expect that this market is suddenly going to settle down. I don't believe that we've quite seen the lows. We haven't had a capitulation selling event yet. We don't have to have one of those, but that would certainly make life easier, because once you get one of those, you generally know that you've seen the worst of the selling. I think at the moment you need to seek out low-risk growth businesses, so businesses that do have high earnings visibility, and I'll cover that again for about the third week in a row because it's just such an important slide. First of all, find great businesses that have got high earnings visibility, and that gives you relatively low risk. And then buy them when there's been significant selling has just taken place, because even great value and tremendous growth businesses can still be sold down more heavily because of emotions. So the fact that they're great value doesn't protect you very much at all. But what does help protect you is that the significant selling has just taken place. So if you can put those two things together, then you've generally got a pretty low risk opportunity, and then it's just a matter of time before we get a rebound. Portfolio analyst this week, I'm going to be looking for opportunities in energy, as I mentioned, because there's certainly some good signs at the end of last week. And I'm also looking for alternatives to the local banks. So last week I covered the fact that I just can't get excited about the Australian banks one little bit, and that I think there's a reasonable chance that the next couple of years of dividends could get wiped out by capital loss of an equivalent amount. And so then the obvious then follow-up to that is, well, what do you like in the top 100 that, that is attractive from a risk-reward point of view? So I'm going to be looking at that alternative this week. Here's the model again. Just go through it very quickly. So this is the ideal stock I'm looking for. High earnings visibility because of all of the factors that lead to high earnings visibility. Strong free cash flow. Earnings per share growth above 20% for the next 2 to 3 years minimum. Close to a bottom in the typical PE band. And a meaningful sell-off in price. If you can tick all those boxes, then you've lowered your risk very, very significantly. And you've opened up the opportunity for some good short to medium term upside. There's my contact details for those that aren't members, and lots of good things happening in Portfolio Analyst. So if you haven't been on the $1 trial, then I think it's certainly worth having a look at. That's it for this week. Cheers.